Bitcoin's value experienced a sudden 200 billion drop within minutes after reaching an all-time high of around $104,000 on Thursday. This volatility was likely caused by a combination of factors like profit-taking by early investors, regulatory concerns, and technical trading patterns. The cryptocurrency market is known for such fluctuations, highlighting the risks associated with investing in digital assets. While the reasons behind the drop are complex, this event serves as a reminder of the need for caution and risk management when dealing with highly volatile assets like Bitcoin. We can see that Bitcoin had been in a sideways phase since around November 21st. Then, on the evening of December 4th, Bitcoin broke out of this sideways movement with a trading volume well above average, a strong confirmation of the upward move. However, if we look closer at the chart pattern, we see that at around 9 p.m. on December 4th, we actually broke out of this small sideways range, but the price was pushed back down, liquidating some initial positions. Ultimately, though, we ended the day with a 0.5% gain. There was another tiny sideways movement after that, with declining trading volume, a positive sign. Finally, on December 5th, we saw a massive breakout, clearly visible from the significantly higher trading volume well above average. Then things got really exciting because in the afternoon of December 5th, Bitcoin fell below the exciting mark of around $100,000, a potential support zone. However, this support did not hold properly as the price broke through it with above-average trading volume. This would have been a warning sign for anyone watching the market closely. It gets even more interesting when we look at the evening hours of December 5th on the 1-minute chart, where the picture becomes quite spectacular. But before that, it's important to keep in mind the other support zones and areas in the price trend where we saw additional buying and price defense against further losses. These included the $16,200 level, which had acted as support on multiple occasions, as well as the $15,500 to $16,000 range, which represented a significant demand zone for Bitcoin. For example, there was support around the $98,000 price range, and then there was another exciting support level slightly lower, around $97,600. Let's mark that approximate level. Now let's see exactly when the $200 billion was essentially burned. It was around 11:20 p.m. In the following minutes, we saw the price in a downward trend, but the trading volume was not really above average. We just witnessed losses of around 1.5% within half an hour. It was interesting to observe what happened when the price broke through all these supports, which occurred around 11:26 p.m. We can see the price breaching these three support levels. Of course, there were some buyers trying to stabilize the price then, evident from the interim low around $96,700. But the price was only defended briefly before continuing to slide. Ultimately, Bitcoin closed that minute around $97,200, a rather difficult sign as we broke through all supports with high trading volume. About a minute later, around 11:27 p.m., we broke through the $97,000 support with high trading volume. Something significant was happening based on the huge order flow. At 11:28 p.m., Bitcoin fell 4.7% in that minute. The sell-off intensified, and within minutes, Bitcoin plunged below $92,000, triggering a cascade of liquidations across exchanges. The sudden volatility caught traders off guard, leading to a frenzy as they adjusted positions. The market experienced a whirlwind of activity, with prices fluctuating rapidly as buyers and sellers battled for control. To understand what was happening, we need to consider stop-loss orders. These are commands to automatically close a position and sell if the price moves in an unfavorable direction, such as falling below certain price marks, like the support levels we identified around $98,000, $97,500, and lower. Stop losses are one factor, but we also have to remember there are traders using leverage to amplify their Bitcoin exposure, not just unleveraged investors. The problem with leverage is that all price movements are exaggerated. If the price moves against your leveraged position, even marginally but more than expected, it can trigger an automatic position closure. This can then cascade into a chain reaction of liquidations across multiple leveraged positions. There may have been a leverage flush here, where a significant number of leveraged long positions opened beyond $100,000 were automatically liquidated once Bitcoin dipped slightly below the key $98,000 level, exacerbating the sell-off. The fact that this happened algorithmically and likely in bulk corresponds to the strong reaction we saw in the price plummeting. You can imagine the interaction between normal stop-loss orders and expiring leveraged positions fueling this massive move. The question is, how should we react when we see such a sharp price drop in a massively liquid asset like Bitcoin? It's crucial to remain calm and rational during volatile events, as overreacting can lead to poor decisions. Experienced traders often view sharp drops as potential buying opportunities, but only after carefully analyzing if the underlying fundamentals remain intact. In such cases, we have to be aware that these types of flashes can occur again, where positions are automatically closed for no fundamental reason, driven primarily by trading algorithms panic selling without real justification. In my view, a good response for short-term traders would have been to build up a position shortly after this event around 11:29 p.m., as I believe it was largely algorithmically driven. We can see Bitcoin recovered well in the following minutes, rising up to 5% within just 10 minutes, an insane move. This teaches us that when we see such dramatic moves in very stable cryptocurrencies, in the short term, we can consider building a small position if we are long-term Bitcoin investors who believe in its growth story beyond just speculation or euphoria. The bigger question is where exactly to place stop losses, if at all. In my opinion, it always makes sense to at least mentally set stop losses. Consider under what scenarios you would want to exit. Stop losses are often hunted. There are attempts to drive the price towards areas where many stops are clustered in order to trigger them and buy cheaper. Such areas include previous support levels and price points where buyers were active before. If you set your stop loss right at these levels, it can become problematic, as we saw on December 5th with Bitcoin. So, it's important to place stop loss orders a bit below obvious support areas if implementing them, because a lot can happen around those levels. More generally, you should ask yourself whether you truly want to enter a stop-loss order or just use it as a mental discipline exercise. The problem with hard stop-losses is you risk not sticking to your plan. On the other hand, without an order, you are exposed to events like this Bitcoin flash crash. You have to weigh the trade-offs and differentiate your approach accordingly. This was a small insight into what happened with Bitcoin's dramatic move. We can see Bitcoin has stabilized again in the meantime, currently in a sideways range and even trying to break out. However, there are still some resistances Bitcoin will have to contend with, particularly in the vicinity of around $100,000 and just over. The current trading volume is above average, as we've seen in the last few minutes, but not yet significantly high in my opinion. It remains to be seen how the price reacts near the $100,000 level. That was the analysis of Bitcoin's move. I'd be very interested to hear your views on the potential drivers behind this market move. Additionally, I'm curious to get your thoughts on what topics you'd like me covered in future videos. Perhaps we could explore more in-depth technical analysis, fundamental factors impacting markets, or strategies for risk management. I'm always aiming to provide content that resonates with your interests, so your feedback is invaluable. Otherwise, we'll see you in the next video, where I'll dive into another fascinating market event or concept. You have to ask yourself where exactly to place stop losses and whether you want to use them at all. In my opinion, it's wise to mentally set stop losses and consider exit scenarios under different assumptions. Stop losses are often harvested, meaning there are attempts near price areas with many stop losses to drive positions into selling and then buy cheaply. Crucially, have a well-defined risk management strategy and stick to it consistently, as emotions can cloud judgment and lead to impulsive, losing decisions. Positions and where people often look for stop losses, potential support areas, places where buyers used to enter, which you now see as areas where some buyers are expected. If you set stop losses there, it can become problematic, which is why you should set your stop loss a little below the supports. A lot can happen around supports that could hurt, as we saw during recent market volatility, where supports were temporarily breached before price rebounded. Giving a bit of room makes sense from a risk management perspective. Development in Bitcoin on December 5th. This is very important to note, and generally, in my opinion, it just makes sense to ask yourself the question: do I want to enter a stop loss here directly, or do I want to use this as a mental experiment and discipline myself? Because the problem is, if you set up a stop loss cognitively, you run the risk that you might not stick to it. On the other hand, you are also a bit protected from developments that are very clearly visible here, namely that there may simply be some of them. Drive the course accordingly in an area where a lot of stop losses are activated and where there are also subsequent purchases from all those who know where to look for all these to loss commands. And accordingly, you have to differentiate a little bit. That was a small one. Insight into what happened with Bitcoin. We see that Bitcoin has stabilized well again in the meantime, is currently in a sideways movement, and is currently even trying to break out. But there are still some resistances that Bitcoin will have to contend with, among other things, in the vicinity of around 100,000, a little over 100,000 US dollars. And the trading volume is currently above average, as we have seen in the last few minutes, but not yet that significantly high, in my opinion. A bit of a question about how the price actually reacts near around 100,000 and a little over 100,000 US dollars. That was definitely the little analysis of Bitcoin. Write me in the comments what your opinion is, whether you think that there were any stubble orders here or any other things that basically ensured that there was this massive reaction. I would be very interested. Otherwise, we'll see you in the next video. It's good. And don't forget to give me the answers in the survey that I'm looking for. I included a little survey in the video description, and I ask a little bit about what topics you're interested in. So if you didn't take part, be sure to do that. Additionally, I appreciate your engagement and feedback, as it helps me create content that resonates with you all. And otherwise, we'll see you in the next video. See you next time, and ciao.